Meta is facing extreme volatility recently due to its ongoing child safety and addictive platform design trial. The trial could result in massive financial penalties ranging from $200 billion to upwards of $1.4 trillion, sweeping operational mandates to alter algorithms. Now, the main question is this a one off event where Meta pays a few billions and shoves the matter under the carpet? Or does it lead to a fundamental change in algorithm which might not be as effective in attracting advertisers? Let's look at some past precedents. Recent addiction verdicts in 2026. Just months before this current federal trial, Meta faced smaller scale test cases regarding youth safety. In March 2026, a jury in California found Meta negligent for designing addictive platforms, awarding $6 million to a single plaintiff who suffered from severe mental health issues. Separately, a New Mexico court ordered Meta to pay over $567 million for misleading the public about child safety. Meta did not accept the verdict. They immediately filed appeals arguing that social media addiction is not a recognized medical diagnosis and that they cannot be held liable for third-party content. And they did not make any changes in the product or algorithm. In 2019, this is the closest parallel to the financial threat Meta faces now. Following the Cambridge Analytica scandal, the FTC investigated Meta for violating user privacy. The investigation concluded with a record-breaking $5 billion penalty. Meta agreed to pay the fine, which, while massive, was a manageable fraction of their revenue to avoid a drawn-out trial that could have forced them to admit to more damaging details. Instead of changing their core business model, selling ads, they agreed to create an independent privacy committee and add new layers of compliance oversight. Critics argued this was a parking ticket that allowed them to keep their data harvesting model intact. Now coming to the Cambridge Analytica case in 2022. After years of litigation over the 2018 data harvesting scandal, Meta faced a massive class action lawsuit. They agreed to pay $725 million to settle the case just before the CEO was set to be deposed. Crucially, the settlement included no admission of wrongdoing, allowing them to maintain that they were victims of data misuse rather than perpetrators. In summary, Meta uses the following playbook whenever they face legal action. Argue that research on social media harm is inconclusive and blame complex factors. For example, teen mental health is complex. Roll out safety tools like quiet mode or supervision to show regulators they are self-regulating, often timed to coincide with hearings. If a loss looks inevitable, pay a massive settlement to avoid a verdict that sets a legal precedent which could trigger thousands more lawsuits. When it comes to rating Meta as a business, it's a quality compounder. I did a video on Meta explaining in detail why I think Meta is cheap at current prices. Be sure to check it out. Meta has 3 massive rocket engines firing the company straight into space. Look at these operational metrics from the latest report. Engine number 1. Daily active people are up 4%. Think about that. Nearly half the planet logs onto a Meta platform every single day. Engine number 2. Ad impressions increase by 19%. They are putting more eyes on more content than ever. Engine number 3. Average price per ad increased by 12%. Not only are they showing more ads, they are charging more for them. When you fire all 3 of those engines at once, you get a business that grew revenue at 33% last year, boasting a jaw-dropping 10-year compound annual growth rate of 27%. For everyone worrying about Meta's massive infrastructure spend, this growth proves the CapEx is already paying off. Meta doesn't just hope AI works. They have immediate, highly profitable ways to monetize it. First, they use AI to intelligently place ads, finding the exact psychological moment a user is likely to click. Second, They're giving advertisers advanced AI tools to build better, high converting campaigns right on the platform. All of that directly expands their ad revenue. So, is Meta actually a buy at today's prices? Let's look at the valuation. If we assume a 14% earning per share growth rate for the next 5 years, which is actually the last 5 year compounded rate for Meta, this is 5% below the analyst projections, by the way, and we take last 5 year average price earnings multiple for Meta of around 22.08, we can see the share price reach $685 this year and $1,321 in 2031, a 19.33% compounded annual growth rate, which beats most other stocks in the market today. So, do I think Meta is interesting at current prices? The answer is definitely yes. I think it's not hard to fathom how they're going to monetize increased CapEx spending. Yes, it does increase risk, but one could argue that it's actually more risky to not increase CapEx spend. Plus, they will again pay a few billions in fines and introduce some tweaks to safeguard children, and then it will be business as usual. Cheers.